A balance sheet is a critical financial statement that provides a comprehensive snapshot of a company's financial standing at a specific point in time. It details the company's assets, liabilities, and shareholders' equity, which together represent the financial position of the business. The balance sheet is divided into three primary sections: assets, liabilities, and equity, each containing specific line items that give insight into different aspects of the company's financial health. The assets section of the balance sheet is where the company's resources are listed. These are things the company owns or controls and are divided into current and non-current assets. Current assets are those that the company expects to convert into cash or use up within a year. This category includes cash, accounts receivable, inventory, and other short-term assets. Cash is the most liquid asset and represents the money that the company has on hand or in bank accounts. It is essential for day-to-day operations and for meeting immediate financial obligations. Accounts receivable are amounts owed to the company by its customers for goods or services that have been delivered but not yet paid for. These receivables are expected to be collected within a short period, typically within a few months. Inventory consists of the goods that the company has purchased or manufactured and intends to sell. This can include raw materials, work in progress, and finished goods, depending on the nature of the business. Other short-term assets might include marketable securities, which are investments that the company plans to sell within a year, or prepaid expenses, which are payments made in advance for goods or services to be received in the future. Non-current assets, also known as long-term assets, are resources that the company plans to hold for more than a year. This category includes property, plant, and equipment, PP&E, intangible assets, and long-term investments. Property, plant, and equipment represent the physical assets used in the company's operations, such as buildings, machinery, and vehicles. These assets are used over multiple years and are gradually depreciated to reflect their decreasing value over time. Intangible assets, such as patents, trademarks, and goodwill, represent non-physical assets that still hold significant value for the company. Patents give the company exclusive rights to a particular technology or process, while trademarks protect the company's brand. Goodwill arises when a company acquires another business for more than the fair value of its net assets. Long-term investments include stocks, bonds, or other financial instruments that the company intends to hold for more than a year. These investments are typically made to generate income or to exert influence over another company. The liabilities section of the balance sheet lists the company's obligations, which are divided into current and non-current liabilities. Current liabilities are debts and obligations that the company expects to settle within a year. This category includes accounts payable, short-term debt, and accrued expenses. Accounts payable are amounts the company owes to its suppliers for goods or services that have been received but not yet paid for. These are typically settled within a short period, often 30 to 90 days. Short-term debt includes loans and other borrowings that are due within the next year. This could be in the form of bank loans, commercial paper, or other financial instruments. Accrued expenses are costs that the company has incurred but has not yet paid. These can include wages payable to employees, interest payable on loans, and taxes payable to the government. Non-current liabilities are obligations that the company does not expect to settle within the next year. This category includes long-term debt, deferred tax liabilities, and pension liabilities. Long-term debt consists of loans, bonds, and other forms of borrowing that are due in more than a year. These are typically used to finance long-term investments or major projects. Deferred tax liabilities arise from differences between the way the company's assets and liabilities are treated for accounting and tax purposes. These liabilities represent taxes that are owed but will not be paid until future periods. Pension liabilities are obligations to pay retirement benefits to employees. These are typically long-term commitments that the company must fund over time. The final section of the balance sheet is shareholders' equity, which represents the owner's claim on the company's assets after all liabilities have been paid off. Shareholders' equity is made up of common stock, retained earnings, and additional paid-in capital. Common stock represents the ownership shares issued to shareholders. Each share gives the shareholder a claim on a portion of the company's assets and earnings. Retained earnings are the profits that the company has generated over time and decided to keep rather than distribute as dividends to shareholders. These retained profits are reinvested in the business or used to pay down debt. Additional paid-in capital represents the amount shareholders have paid above the par value of the stock. This can occur when the company issues new shares at a price higher than the par value. The balance sheet is governed by the accounting equation, which ensures that the balance sheet is always balanced. This equation states that assets must equal the sum of liabilities and equity. In other words, everything the company owns, its assets, must be financed either by borrowing money, liabilities, or by obtaining funds from shareholders, equity. This balance is crucial for understanding the financial structure of the company. Investors, creditors, and management use the balance sheet to assess the company's financial stability, liquidity, and overall health. A strong balance sheet with a healthy proportion of assets to liabilities and significant equity indicates a financially stable and well-managed company. Conversely, a weak balance sheet with high liabilities relative to assets and low equity may signal financial difficulties and increased risk for investors and creditors. Understanding each line item in detail helps stakeholders make informed decisions about the company's future prospects and risks.